The Nasdaq hit 5,000 this week, and no, it's not the dot-com era of 2000. So what does this milestone mean to investors, and what is different this time around? David Sykes, portfolio manager of the TD Tactical and U.S. Monthly Income Funds. Well, David, the Nasdaq usually, or was always associated with technology companies, but there's more in there. What else is there?
Well, there are a lot of different components to the Nasdaq. And when I think of the Nasdaq, I think about a global exchange, an electronic exchange where you can buy and sell stocks. I think a lot of people also assume it's 100% technology stocks. A lot of innovative companies on the Nasdaq. But if you look at the breakdown, there's 45% roughly that are pure technology. There's about 25% that are consumer services or consumer products. There's also about 15% healthcare, mostly biotechnology stocks, and there's a rough smattering of 7-8% of financials, new innovative financial companies.
So what was it like then back in 2000 versus now?
Well, a lot of people are pointing out that we've crossed that 5,000 threshold recently and trying to compare that to 15 years ago. I can tell you that it's, in my opinion, two very different times. If you go back 15 years ago, March 2000, we crossed the 5,000 level in the Nasdaq. Three things really come to mind for me. First is sentiment. If you go back to that year, March of 2000, everybody was talking about stocks. Everybody was talking about technology, and there was no end to sight. No one mentioned that we crossed 5,000. Now, a year later, stocks were down 50% on the Nasdaq, and then 2 years later, they're down almost 80%. So the sentiment this time around is different. Back then, 500-600 IPOs in a year. Last year, 2014, we may have had 50 technology IPOs. So very different from the sentiment perspective. Second was the whole valuation framework. Last time, stocks were traded on the Nasdaq at 100 times PE, roughly speaking. Today, we're at 20, 21, 22 times. So a much different valuation. And then the third difference really is, back then, in my mind, technology stocks and young technology stocks were concepts. It was about an idea, number of clicks on a mouse pad, eyeballs watching this concept on the screen. Today, a lot of those companies have really transformed into real businesses, real earnings.
Some actually make money?
Yeah, real earnings, real free cash flow, real balance sheets, and even, for a lot of them, real dividends and dividend growth.
So where do you see now the driver is on the Nasdaq?
Yeah, so I think you can't separate the Nasdaq from what's been happening overall with the global equity markets in the last 5-6 years. So clearly we've had a big rebound in earnings, corporate America and corporations around the world doing much better. You've seen earnings power, you've seen multiples expand. That's really helped equities globally. But for the Nasdaq specifically, this year to date, they're up 5-6%. It's really been driven by these large cap, high quality names. Apple is one for sure. So just to look at the top 5 names, Apple's 10% of the Nasdaq index. Then you have Microsoft, you would have Google, you'd have Amazon, Facebook, big, large companies, real earnings, not just concepts anymore, real earnings, real free cash flows, and real return of capital to shareholders as well.
So you've brought me a couple stocks that actually are on the Nasdaq.
That's right.
You like. So let's talk about the first one.
Right. So both of these stocks are listed on the Nasdaq exchange. The first one is Gilead, ticker GILD. Now, Gilead is a biotechnology stock.
It's been around for a while.
It's been around for a long, long time. It's a very mature company. It's probably 150 billion or so market cap. Gilead has been known for being unbelievably innovative in its drug discovery. And they really made a name for themselves in the HIV arena, which used to be a fatal situation. Now, with a lot of their breakthrough technology drugs, able to extend life for many, many, many years. So they have a big, huge share in the HIV space. But more recently, they've made a wonderful innovation in the hepatitis C market. Hepatitis C really attacks the liver. And they have 2 new drugs, Sovaldi and now Harvoni, which effectively, believe it or not, cure this disease. It's really, really a breakthrough. Now, it's a very expensive drug, but this is a true innovative breakthrough. Hepatitis C in the US and globally is a huge market. It's underpenetrated. There are a few competitors that have come in as well as Gilead, but I think there's lots of runway for this company to grow the earnings and the cash flows. The other thing I like about Gilead is they've recently introduced a dividend. And as you know, dividend and dividend growth is sort of a feature of my investing style. And so Gilead now has a 1.7% dividend yield, and we think they can grow that for many, many years to come.
How big are they now?
They're about $150 billion market cap. The free cash flow yield is very attractive at 8%, and the PE, they're trading at 11 times forward multiple. So we're not talking about a concept biotech stock here. It's a really well-run company established in many, many great markets.
And what about the next one?
So the next one is Oracle. I've talked about Oracle before. Ticker's ORCL. Oracle is an enterprise software company. So it's not consumer software. This is large enterprises. And they really have a dominant market share in database software. So database software for a lot of large companies, it's mission critical. It's absolutely vital that that function works, performs well, performs efficiently, used by over 400,000 corporations around the world. The nice thing about Oracle is a lot of those companies have to pay a licensing fee. So there's an ongoing recurring revenue stream there. In addition to that, Oracle also has a new idea where they're going to take their software, combine it with some of their hardware, and actually show corporations that they can run more efficiently and at a cheaper cost. So we think that's going to power their growth going forward. Oracle initiated a dividend a few years ago. They've grown the dividend over 20% clip over the last 3 years. The dividend yield is not spectacular. It's about 1.1, 1.2%, but a nice yield, but the growth rate there is excellent. And again, Oracle, $190 billion market cap company, very established. I would call it blue chip in the technology space, great balance sheet, and I think that's a name you can buy now, tuck away at 14 times earnings, and look back at some very favorable returns.
So these are pretty much big blue chip companies. Now, I'm just thinking, as the price of technology, has dropped so much, are they moving to the online space, that sort of thing? Well,
I don't think either one of these companies would operate online. Certainly, they would use technology to promote their drugs online, or perhaps advertise to customers online. But I think the real thing you've pointed out with technology is an interesting one. It's a caution. Technology is fast-paced and it moves a lot. So things can change. These aren't stocks you necessarily want to buy and forget about and wake up in 30 years. You need to monitor and understand. But the current projections for both companies look quite strong. But you always need to be aware of other innovations. If somebody comes up with a better drug, or somebody comes up with a better mousetrap, that can change everything. Nothing in the short-term, medium-term horizon. But as you say, that's one of the disadvantages of technology. There's always that continual search for a better mousetrap, if you will. And that's something you have to be aware of when you invest in technology names.
All right, thank you very much, David.
Thank you.
I've been joined by David Sykes, who's portfolio manager of the TD Tactical and U.S. Monthly Income Funds. I'm MaryAnn. Thanks for watching.